Afternoon, everyone. It's obviously another glorious autumn day, particularly in God's country down here in the Shire. I'm going to take you through a quick update of all the things that are becoming a little bit more relevant now about reopening and working through those practical issues and the cash flow issues about coming back out of hibernation. And then Mariana is going to talk about her JobKeeper obsession, and James will help us with what's happening with the banking structure. No need to laugh so hard, Maz. So everybody is now starting to feel a lot more comfortable. Government's making strong statements. ScoMo coming out today and saying everything's going to be back somewhat normal, whatever that means, by July. And the states are starting to look at how everything gets reopened. So it is now coming home to roost. We're looking at retailers, major retailers opening next week. Maya are talking about Monday, and a few of the other smaller and mid-range and specialists are already starting to open now. I suspect that's to take advantage of zero rent scenarios and just to test the market to see what's happening. Those parties will probably feel a little bit of heat in the next couple of weeks once stock becomes an issue, because the whole supply chain has collapsed. So if you need stock and supply becomes an issue, you will need to restart your supply chain, which is not instantaneous. So although operations may start, getting the supply chain going is probably the next major thing. And considering how that's going to work, while there's long-term social distancing is difficult for a lot of companies, and they're working through those issues now, as well as talking about financing and how that all works. That goes to the private equity guys who are really on the lookout at the moment. We've got a couple of opportunities that we're taking to market, and there is a lot of interest coming through from private equity, which is good because that means that there's an opportunity to be able to look at other options outside of continuing the way it is, and also the worst option which we are involved in, which is a close down. Similar things with Virgin. Virgin is obviously the primary big dollar option at the moment. After last week's fighting at the creditors meeting and between various parties, it seems to have calmed down and everybody's retreated to look at their options, and that will progress over the next few weeks. I suspect we will see similar things with a few other businesses that are now coming through and out the other side of hibernation and don't have a solution. Some of them will be big, some of them will be small, and that will mean there'll be more administrations and more receiverships. There's been some articles in the paper this week on that, and the banks will probably be bystanders, but will be trying to get people to look at things like a safe harbour review to look at the options rather than just rolling along as they are and hoping and praying everything gets better. In terms of the social distancing thing, there is increasing sales in things like sneeze guards for retail and a few other different things. If you look at some of the approaches that some people are doing, effectively they're adopting somewhat of what Taiwan's been doing, which is testing on the way into buildings, so temperature testing and on the way in and on the way out. And then obviously providing some other structures to assist with operations. In our building, I think there's going to be issues around using the toilets because the cubicles are a little bit too close, so they'll have to adjust that and work through those on a practical basis. The phase of all of that comes down to working backwards from a 3-month period of restarting the business and understanding what that cost might be, as well as the impact of your social distancing on a practical basis. So thinking about what is our break-even position going to look like and what are we going to actually generate in turnover, which is the most difficult thing to do in a new business and how that's going to work. The good news is for those who are landlords and alike, that'll create more certainty because turnover should start to level out and become more consistent. So anything under the code, and we've been looking at the code for a few clients and for ourselves, should start to turn back up. Then it's just a matter of funding stock and wages and looking towards when you can get back up to a normal level or a balanced level and how that plays out. There are a lot of clients who are coming to us talking about supply chain and whether they can actually change it now or whether they just need to stick solid and change. So it's difficult to change right now because you've obviously got to test the new supply chain, but that is an option that some people are exploring. And then finally, the thing we've got here is opportunities. There's going to be a major change in lease, so that's an opportunity for some clients to get into sites that they couldn't get into previously at the right price. Automation of business systems is a big thing that people are pushing through so that they can manage their workforce and also operate under a social distancing structure. And there's going to be retraining. We've seen this week the NRL taking all of their current players, even the ones who've been bad boys recently, through how they're going to operate and train and continue through the next 3 months while under the government sort of steady gaze to make sure that they're adhering with a structure. And once that is proven somewhat successful, I'd say a lot of the other sports will follow through. And generally with those things, that will also then transition into some sort of business structure as well. Although the big issue I see with a lot of it is how people on public transports are going to be managed, because that is probably one of those places where there is a chance for a lot of interaction. So that's where we are. There's a lot of practical issues and a lot of phone calls going on. And people are now getting in their teeth into their plans because they can see there's an opportunity in the next 2 or 3 weeks where they will be able to go back to some level of operation, where particularly those businesses with a face-to-face approach. The other businesses are now looking at how that impacts everything coming back up and their markets coming through as well. So that's pretty much it. It's a reiteration of last week, but there is more positive signs that everything is starting to return, albeit with more uncertainty created by having to adapt further. And I'll hand over to James, and James can talk to you about how the banks are adapting.
Thanks, Todd. Welcome, everyone. Look, I do have a couple of slides there. I won't particularly talk to them in any great detail, other than the $250,000 loan, which is detailed there, how you go about getting those and the type of information the banks are looking for. The other factor is that nearly all of the lenders that applied to the government to be approved to provide these loans have now been finalised. So there's well in excess of about 16 lenders. So this includes the banks, regional banks, as well as non-bank lenders. So some of the non-bank lenders that have been only approved very recently are the ones that basically have a higher cost of funds. So most of the major banks and regional banks are providing these loans at around 4 to 5% per annum of interest rate. And they have their minimum requirements to meet, whereas the non-bank lenders that have recently been approved, you'd tend to find that their interest rates are more around the 8s to 10s, or maybe even higher. But they probably look at the loans a little bit more flexibly than maybe what the banks or major banks do. So what I really wanted to have a chat about is what I've been seeing over the last few weeks in particular, the type of people that I've been talking to, and how the banks are reacting. Firstly, I have been really impressed with the banks, regional banks and even the non-banks, around how they've handled customers' needs, particularly in deferring payments for 3 or 6 months. This is both in the resi and the commercial market. I've helped customers that were borrowing well in excess of $40 or $50 million, and it wasn't a difficult process to get them 6 months of deferral. And not only was that deferral of things like interest and or principal repayments, but it was also deferral around their financial covenants that they may have had in place. It's great that it's deferred now. I guess it's more when we look at how they start trading or pick up their trading again is something to think about for the future. But just all in all, really quite impressed. In fact, you don't even need to meet a 30% test. Really, most funders are actually not even asking too many questions as to why you want the deferral. They're largely just doing it if you need it. So that's some general feedback there, and it's quite good to see. But I would say that you should only ask for it if you really need it, because you are ultimately capitalising interest down the track, so that there will be more cost. But if you don't have other avenues to save cash at the moment, it is one that is not difficult to do at the point in time. Look, I don't think there's hardly a business that will be impacted by what's going on. Certainly there are those businesses that are either in essential services or food related or others that aren't being impacted as much. But a couple of examples with a client that runs sort of big box sports type stores. He's got 4 big box sports stores, and he also runs an online business for gym equipment. Strangely enough, his gym equipment online business has just done 12 months worth of sales in the last 6 weeks. But then on the other side is big box retail sports businesses, while some of the items in there are going quite well, are down. So if he puts it all together, he's trading at or around last year's revenue, but really been saved by that online business that he had, and expecting that as we now come through, the government releasing and businesses being able to operate and open and do more things, he sees that he'll be down overall because that online business will fall back, and he's currently putting in plans around how he's going to service and have cash around to fund his business. Probably not right now, but probably in 3 to 4, 5 months' time. Also been helping a group of non-essential services business. So this is mainly in the building sector. They are deemed essential services. They supply to the building and industrial sector, and they're putting in place a whole bunch of working capital lines. They didn't need them before, but they are seeing that their debtors are paying them a lot more slowly than they were before. We're talking about a drop in the debtor days by about 10 days, or an increase in debtor days by about 10 days, which on their revenues, adds millions of dollars to their working capital requirement. And they're also fearful about some of their customers not surviving the next 6 months or 6 to 12 months. So, these working capital lines they're putting in place, they see as a level of insurance, but they do feel that they're going to need to have this in place. If it's not necessarily needed now, it might be needed in 3 to 6 months' time. Some of the other key issues that I see, and Todd certainly touched on this, is that you've got to have your plans starting to be formulated right now. I think there will be businesses that will be able to start more normal operations earlier than others, and those plans you need to be really putting in place over the next 2 to 3 weeks, or starting those anyway. And if those plans need money, and that money's, you need debt as part of a solution for that, then look, we're here to help, we're here to advise, and we're here to make sure the structure is going to be right. This $250,000 loan can be part of that solution. Certainly, if you need more than $250,000, then banks and funders are accepting mixed applications, so you can get that $250,000 loan, and then they'll look at other loans, and they'll look at those other loans more normally, as if they would for if they were approached 3 months ago. But they're happy to package the deals together, and that's something that we can help and assist with. I have got some new transactions running at the moment, and it is quite interesting that the banks that I've been approaching on these are certainly more conservative, and they're acting a lot more slowly than certainly they have in terms of interest rate and payment deferrals. And or if you're an existing customer and you need some changes in your working capital lines or debt lines, they're able to do that a little bit more quickly. But anything new or a chunk of new money, they are taking time, and they are requiring quite a lot of detail around what the COVID impact is, not only now, but as you trade through it and trade out of it. It is probably 30% slower than it was about 8 weeks ago. So if a deal was taking me 8 weeks to get done, we're probably looking at another 4 weeks on top of that for new money. So that's just something to keep in mind, because the banks have been, they're a bit inundated with just handling their existing customer bases, as well as all of the deferrals. The major banks in particular that are big lenders to the corporate sector, they have been inundated by even all of their good customers, which are well capitalized and whatever else, but they're all putting in funding lines to make sure they get through the next 6 to 12 months. So the banks are very busy at the moment. So if they've got something new, it's harder and longer. That's really all I'd like to say. I think that's about it, but certainly the residential market is one that we're still having banks provide reasonable turnaround times. Normally we would get loans done within a week for an approval once lodged. They're probably only about 3 or 4 working days longer than that at the moment, because effectively their pipelines have reduced quite a bit. And if anything, they've probably moved some of their staff to helping their existing customer base more than they are around the new stuff. But we are having quite a bit of success. We are also in the residential market having to make sure that things like the borrower's employed right up until the point they settle a loan. We provided some advice to someone that said, I'm not going to lose my job, I'd still like to go ahead with this purchase. We said, well, are you sure? Because in 6 weeks' time, the lenders will do a check to make sure that you're still employed. She then actually didn't go and buy that property, and ultimately 2 weeks later, she did lose her job. So if she had went ahead, exchanged, you would be stuck in that position, and no doubt the funders may not be there because it's part of their requirements. So all of these sort of factors do need to be considered, and a lot of thinking thought through more than you would normally.
James, is valuations getting impacted yet? Are you seeing that in what you say? Is that moved around too much?
In the residential market, no, not so much. In fact, we've just had one that was approved very recently, a property in Bondi and a property in Leichhardt. The bank in question did desktop valuations because of the difficulty of getting valuers into properties at the moment. And those desktop valuations came in at purchase price and at a reasonable level for the existing property. So I think it's still a little bit too early. I have been talking to some professional valuation firms, and they do expect that things need to wash through over the next 3 months or so. Certainly in the commercial market, people like listed REITs and these sorts of things are already taking actions, whether they're raising capital or doing other things, because they do see that there's going to be an impact on valuations and therefore how their businesses operate. But it hasn't washed through yet. But I think you've got to allow another 3 to 6 months before we're starting to see some of that stuff. Otherwise, I'll hand over to Mariana.
Thanks, James. And I assume they've got that hotline for the banks that you can just rip money out of the banks and pay your staff very easily, very quickly.
With your existing bank, they are able to provide. Is this for the JobKeeper you're talking about?
Yeah, that's right.
Yeah, they can provide short-term money to have your JobKeeper paid if you've got a working capital issue for a month. They need to have it firmed up that you're actually lodged and approved, and you've got better terminology than me, Maz, but
Yeah, I heard that they were giving the bank was giving their bank accounts, so the JobKeeper would go into the bank account's bank.
Yes, it
Yeah,
has to
so
be.
bank, yeah, so
the account you nominate has to be their account.
yeah, that's right.
Yep. But they're being like that sort of stuff and deferrals. They're being really quite good.
Yeah, thank you, because that's a very practical issue.
Mm.
And look, I think with the JobKeeper, we've still got a few people on the call here. Probably some people are still assessing it because there new bits of legislation has come out. So as we know, big picture, the main legislation came out, and that was great, and a lot of people got on with it. But then we had a lot of people didn't meet the basic test, so they went to the alternate test, and that came out 2 weeks ago, and that was fine, and some people met that. And then we went to, well, actually I'm a service entity, or I've got other bits and pieces, a lot of the not-for-profit area, being, grants, do we include that in our calculations, etc. So a new piece of legislation has come out for that, and so that's where I'm going to probably focus on, not so much on the not-for-profits, that's tomorrow, it's more on the bit on the service entity. But just to recap here, you can never say it enough, and maybe some people in this call haven't been to the other webinars. But eligibility is about identifying if you have assuming you're in business, of course, on 1 March, you have a decline in your income, projected GST income or actual income, and how you calculate that becomes the question, and I will touch on that. There's an alternative test if you don't meet the basic test. So if you meet the basic test, don't go any further. You don't need to do anything else. And you only test once, so there's no retesting happening. Alternative test, I'll go through in a minute. What does that mean? What does it look like? When do you use it? Now we know that you've got to have paid $1,500, and that was extended to the 8th of May, which is Friday, 2 days away. Still got time. And if you're self-employed, that's probably the easiest. You don't have to pay yourself any top-up, and you don't even have to do a nomination form. You just go and enrol, and the enrolment in itself is quite simple. It's just the consequence of if you got it wrong. And I don't mean the enrolment itself, but when you progress from there. Eligible employees, there's been a lot of discussion about who are permanent staff and part-time. That's probably a little bit easier to understand, but they're casual. What's a casual employee? Like, they've been with us 12 months, so from 1 March 2019 to today, that's easy enough. But what does regular and systematic mean? And that's been a question that some have been asking. And regular is regular, routine, often, maybe once a week, maybe, once every fortnight. Systematic or is about, being able to show that they're on a roster. One example is a waitress in a restaurant. They're rostered on all the time. It may be a not-for-profit, you're a volunteer, or not a volunteer, but a casual in a catering. So you've got rosters to go on to, and they're pretty regular from that angle. But it is a bit unclear, and there is some definition in the Fair Work Act. So anybody needs that, please let me know. They identified that full-time student who is 17 years or older or younger, who's not financially independent, is ineligible for JobKeeper. So if they're financially dependent, no problems, and so on. So it has been a little bit about, what about these employees? And say I pass on the employer test, the question has been a little bit about, well, I need to get the nominations out, but I haven't got all my signed nominations. And you need your signed nominations to pay the top-up tax, because you've got to know. Now, why is that? Well, the nomination form is really telling the employer that they're choosing you, nominating you to be the employer to do the JobKeeper. So in some cases, you might have a casual, they might have a permanent job somewhere else. And so that employer really is the one that should select them for JobKeeper. Now, if the other employer is not entitled to JobKeeper, technically they're not entitled either to it because they have another permanent job, so they're disqualified. So it's about identifying the eligibility of the employee. The employer is not going to know that information necessarily, so they'll have to ask that information. They'll know who's there on 1 March. They'll know if people are on visas, but they won't really know some of those other questions. And so that's why it's important to get these nominations out. The ATO has a pro forma, but you can choose your own pro forma. So there's no need to use theirs. So if you've got a HR portal system that you use to get, push out information, use that. And the ATO has identified what information needs to go on there. Basically all the criteria. Do they meet the criteria? You don't need those forms to be signed, but you need to have something that acknowledges the employee has met the criteria. So you could send the form, the employee looks at it, is on holidays, can say, yep, look, they meet the criteria in an email, and that should be sufficient until they get that form back to you. And if you want to, I mean, some are doing it on DocuSign. I thought that was a really good idea because I've used DocuSign and it's pretty fast and efficient. So they've passed, you've got the nominations and you've paid the top-up tax by Friday. So, not much time there to get all your nominations back and then top them up on Friday if you need to top them up. And then you've got to, the important thing you've got to do is go on your single touch payroll. If it's upgraded for JobKeeper functionality, very easy. You've got till the 8th to do this, so Friday, but you have to select which employees are eligible. So from your notice and the fact you've paid them, then you identify it. And there's some little quirky things about fortnightly payers and monthly payers and so on, but happy to chat with anyone on that specifically. The one in all in has got a few people niffed a bit, because what happens in a situation where you have nomination forms sent out and some employees, and I don't know who exactly, but you know your employees better than I do, and they just don't send them back. They can't be bothered because maybe they're eligible, but they don't care because they're going to get their salary. So it's bad luck for the employer. But effectively, if you don't get those forms back and they don't acknowledge it, then they won't be entitled to, or you won't be entitled as an employer to the JobKeeper. Nor will they, by the way. You don't have to pay them top up. Even though it's one in all in, you still need that nomination form. It just means that in a scenario we had previously, you had 30 employees and you did not have the cash to pay the 30. So that all, eligibility is fine, nominations are fine, but you just didn't have the money. And so you select 15 of them to pay now, and then once you got the JobKeeper, you could pay them the next month. And the answer was no. And hence why the banks have got, Quick Smart, got some, lines of credit in there so that they could give them some cash flow, working capital, and then effectively, get that money back from the government through their bank account, so they're not at a loss. They know they're going to get that money. So it was quick and easy. Otherwise, the 250 loan or any cash flow or any overdraft about 2 weeks ago would have taken you 2 or 3 weeks to get. So it would have been very difficult. Can I go to the next slide, please? So the biggest thing, maybe there is some organisations out there at the moment still working on this, the basic test. Now you have a choice of doing it monthly or quarterly. So you can choose the month of March or April, or the quarter of April, June. Now, if you meet it in any of those three, that means you start getting the JobKeeper from 30th of March. Very important. Now, if you don't meet the basic test because you don't have a comparable, and the question is, what's comparable month? And I like to say that, it's not what you might not have the month of March or April because you started, or you've got irregular income, or you have increase in income, or you've done a restructure. There's many reasons. So you might not have that. And so hence you can't meet the basic test. And so the commissioner has issued his discretion and has issued it saying that only for certain types of entities. So he's issued the discretion for 8 types of entities, which we'll go through in a little bit, and under the alternative test, which we'll discuss after this slide. So that's why you might not have a comparable. You don't actually need to seek the commissioner's discretion. You don't go over to the commissioner and ask him, oh, can I get your discretion? No, just by falling, just the ability that it's there and you meet the criteria, because there's a kind of a test before you actually apply the comparative, if you like. So if you meet that test, then you're in. Now, there are some tricks about it, and I'll go through that when we look at the next slide. But what is projected, oh, no, sorry, go back. So what is projected turnover? If you're just looking at the basic test, the question is, what do you include and what you don't? And this has been a real big topical thing, right? So it includes generally the best, the simplest to say is go to your March BAS look at your taxable supplies, your GST-free supplies, input tax supplies, take out the GST, take out your input tax. That would generally be what your taxable supplies was for March 2020, and do the same for March 2019. Don't get a 30% reduction. Do the same for April. Now you may do those tests, and you may be difficult for you to do a quarter, and then you go, no, it doesn't quite work. It's not make sense. Blah blah blah. So what the Commissioner just did on, or the Tax Office on Monday, was issued a law companion ruling. It's not binding. This is at 2021. And it gives you a guide how to calculate your decline in value. And it gives you a choice. It gives you a bit more scope. So for those, now I just want to emphasize, for those that have not already calculated, then this is just opens up an opportunity to look at it a different way. So you could do it, instead of doing it on your BAS basis, you might be doing projections for April to June, and you're trying to wonder, how do you do projections? It gives you some guidance there. And it says, you know, on what your projected could include and what documentation to include. And it also looks at, you could use your accounting instead of your BAS. So all these little options. Now, don't panic if you've already done it. And if you already meet it and you don't need that, don't worry. And the Commissioner was saying this was just an extra assistance. So don't go back and retest. Don't go back and do things differently. If you've already done it the way it was done, and when the law was out and the information was out, stay on course. No need to go further. So I was talking about the Commissioner's discretion there. So if I go to the next slide. So the Commissioner has made a discretion to apply these alternative tests. Now you cannot go and request another test or a case-by-case to the Commissioner. This is not like a private ruling where you go to them and say, can you give me guidance on this? Or can you look at my scenario? No, he will say, no, I have issued my discretion, and that is being issued by giving that legislative instrument, the legislation, which is these scenarios here. If you fit under one of these scenarios, or maybe you fit under 3 scenarios, you choose the one that's best for you, and that's okay. So we've worked out we don't meet the basic. If we met the basic, we don't go any further. We don't need to apply this. But if we're going to look at, okay, the basic doesn't work for us for whatever reason, we don't have a comparative. And you know, what is a comparative? Is it a month? I thought it was just that you didn't have the month. Could be that your income is irregular. And that's one of the tests here. So if you look at it, commenced business, and it just gives you a different test period. Now, I won't go through each one of those tests. I can ask you a question at the end of my chatting away, and you can ask me and I can go through any particular one of these that you feel you'd like to know a little bit more about. That's probably a better way to do it, I think. The ones I like and I think we've been using a little bit more of is commenced business, substantial increase in turnover, or irregular turnover. Now, the thing about irregular is that you don't have a comparable month, and it's non-cyclical business. Now, define cyclical, I had to look it up because it doesn't really, the legislation, define it at any, and if there's no real definition, then you can go to Dr. Google and get sort of an idea of what a definition would look like. A cyclical industry is an industry which is sensitive to the business cycle of the economy. The revenues from the industry is generally high during economic prosperity and expansion. Cyclical sectors are basic materials, consumer cyclical, financial services, real estate, and it goes on. So, and it also has an example in the EM, or the explanatory statement, saying it might be a fruit grower. That was very explanatory, I thought. So, you know, it is a little bit about, you have to make that call, and we can request more information from the ATO, but it's more about timing, because, you know, we've got to the 8th, which is only 2 days away. The other one was irregular turnover. So some businesses have very lumpy turnover. That was one we just talked about, didn't we? Yeah, we did. So that was the one that, so long as it's not cyclical, then you could look at and applying this. Substantial increase, that you've got a new business, you've already had a comparative month, but you've had substantial growth, or you've added to your current business back in 2019, you might have added new business lines. So you might use that test, and so on. Might have been that you were in the disasters, the bushfires, and there's certain exemptions there. So if we go to the new slide. So any questions at the end, just ask me if you want to know how one of these particular ones work. So the next bit of legislation, so the third bit of legislation that came out this week was the alternative test for service industries. Very interesting here. So those that are, so this is business, it doesn't matter what industry you're in, okay? It doesn't classify by the industry, but whether you're a service entity. And a service entity usually is an entity, a trust, a company that employs all the staff, or you might have 2 or 3, and it has charges a management fee to all the operating entities within the group. Now, in the case that this alternative test, it's talked about a tax consolidated group or a consolidatable group or a GST group. Now, do you fit into one of those 3 scenarios? Well, you know if you're tax consolidated, you know if you're consolidatable because you've probably got a head entity, subsidiaries, but you just haven't consolidated for whatever reason, tax consolidated, or you're a GST group, then you know you're a GST group. So that's easy. And then what it goes on to say is that you, instead of take the turnover of the service entity, because it's unlikely that has had a reduction, because it's just mainly management fee, which is the cost plus an amount, unless you've kicked out a few staff members and made them redundant, right? Then what happens is that the individual companies, the operating companies that are charging the management fee, you look at their revenue. So if you've got 2 or 3, you group them together and you look at the revenue as one, and you compare 2020 to 2019, March or June, etc. So like for like. And then you can also further, so is it get a reduction? Now you might even have a situation where, geez, you've got this tax consolidated group, but you've had a restructure, which is one of the other alternative tests, or maybe you're in a startup. So then you can actually apply, you can go from there and apply also one of the other alternative tests. So it gets complicated, but there's scope there. That's what really you need to be aware of, that you might come within the rules. Another thing they brought out is this guidance. Now this is, it's basically a, what would you call it? A practical compliance guidance. So it basically talks about, you know, when are you doing something wrong and when are you not doing something wrong? And what are the things that they consider that might be a little bit outside of the ordinary? So it addresses a scenario where a service entity, you might have a service entity that's not tax consolidated, so it doesn't meet that criteria. So it's outside of falls outside of tax consolidation, GST grouping, etc. So this practice compliance guide basically says that effectively the commissioner, it's a low risk that you could actually apply this methodology and the commissioner is likely not to review. And what is that methodology? What it says in the ruling is that should you have your service entity and your operating entities, the operating entities have that reduction of 30% of their income, and you can't apply this test because you don't meet it, but should you reduce, not through this, you don't change your service agreements, but should you reduce the management fee by that 30% reduction or whatever it is, that's effectively a low risk. So if you did that, it's low risk that the ATO would look at it, but you could fall then within the JobKeeper scenario. Just got to be very careful with that, but that's something that we can look at. So very interesting, the service entity and whether you fall in or out. So registered charities, they can elect to exclude or include government grants. One thing I wanted to say there is that if you do exclude government grants, you have to have a written election made to the commissioner, but the ATO. But again, I don't know what that looks like. We haven't seen what that looks like, but it has said 7 days. But I assume that if you've got 31 till the 31 May to make some enrolments, I'd say you'd have till then to actually give that notice. I don't think I have too many not-for-profits, so I won't go any further in that, but I'll discuss that further tomorrow for the not-for-profits. We can go to the next slide. I think we're on the home run now. Not just me finishing this presentation, but we're on the home run from the perspective of, okay, a lot of you have already assessed, and some of you are on the cusp of assessing, but you just need a little bit more information. We can certainly assist you with your eligibility. Did you have your decline in turnover, the calculations, alternative tests, etc. Just to be aware that the online application is on, it's ready. But before you go an online application that takes you 2 minutes, make sure you've got your employee nomination forms. Now, you may not have all your employee nomination forms, but you've got a pretty good idea. And in your enrolment, you might say you've got 20 employees or something like that. And then you find out one of them, you get your employee nominations back and it's actually got 19. Don't stress, because I think so long as you get the employees right and when you complete your single touch payroll, and if you have JobKeeper functionality by 8th of May, you pick the right employees. So you pick the ones that have given you the nomination form. You shouldn't have any problems. You shouldn't have to go back and fix the enrolment, but you should just be able to have evidence as to why you chose 20 instead of 19. Now, if you don't have JobKeeper functionality in your single touch payroll, that's fine. The business portal, you go in that way. Now, another thing that you need to be aware of before you get your money is you'll have to identify, it's very easy to do, identify what your current turnover for April is and your projected turnover for May. Now, how do you calculate that? Some people have been asking me. Well, the main way to calculate it is how you calculated your entitlement for eligibility on the 15% reduction. So if you calculated it using your BAS figures, use that, excluding the GST and excluding the input tax. So do it the same way. So like for like. And if you're using projected, do the same thing. So just calculate it the same way you calculated your reduction of turnover test when you to enter into the JobKeeper scheme. If you did it a different way, use that way. That's all I'm suggesting, and that is what the ATO has mentioned. Now that is open, and if you do it before the 8th of May or just on the 8th of May, you should be getting your money next week, and that's the important bit. Now, if for some reason you've delayed, you've done the top up, but you haven't enrolled, and you haven't got all your nominations, you've got till 31 May, but just be aware that you won't get your April payment until June, the first week of June. That's more likely. Okay? And then going forward, I think you just need to be careful that you make your payments within the fortnightly cycle, or if you're less frequent, within the month of that May period, meaning you've topped up everyone. I think that was all on my slides, is that right? I'd be interested to know if anybody has any questions, specific questions. It's always easier to answer, I think, some questions.
I'll answer. There's a couple of questions up. I'll take you through them, Maz, and you can answer.
Thank you.
Okay. Shamil has asked, are the companies required to have 30% reduction in sales over the next few months to keep claiming JobKeeper payments? I thought not, but the ATO is asking for this every month. Do you know why? It's the monthly reporting requirement.
That's right, Todd. Thank you. Yes, you only do it once, and once you meet it, you don't need to retest. So this is only simply for the purposes of, well, the ATO say that it's for collecting information to see the effects of JobKeeper. I think they will use it in some way to look at, well, what was your BAS saying, and maybe just see how good your projections are. But what they are saying, it's only for reporting. It's not to retest it. And I don't know what they're going to use it for, really. I mean, no one really knows. Big data.
Yeah, I mean, I think the feedback we've had from them is that it's going to be part of their sense check to make sure that what you've given them is realistic, and be able to look through it. And that's logical, right? Because they are concerned, and one of the divisions they've set up in the last couple of weeks is the monitoring division, to actually make sure that if there are people who they think are breaching protocol, that there is somebody watching and will take action pretty quickly. In the words of the person I spoke to, we don't want anybody taking the piss.
No, and I think it's about, to me, it's about documentation, because how you interpret a lot of these things aren't that clear. there's not enormous amounts of guidance, although there's a lot of, I've got a lot of paper on my desk. There's not a lot of guidance on definitions as such. Like, what's a comparable month? Like, a comparable period says the month prior in the same, you know, a month in the prior period. It doesn't say it's got to be the same. Doesn't mean, it doesn't say anywhere that it's got to be like for like. It's just because they will use the word comparable, it's assumed. So, you know, there's things like that that aren't very clear. So as long as you document and what you've done is reasonable, I don't think the intention isn't to, you know, take this off you. The intention is to help the economy, and you are feeding it back to your staff, or you are using it somehow in your business.
And our view is still that if you are thinking you're on the threshold, park the money, get the money, park the money, and deploy once you've had a chance to review, so that you don't have the worry about actually getting the money. You have it, and if you do not in the end need it because you do better than what you expect, you have the money parked off to one side and you can actually return it.
Yeah, and that's if you haven't met the March, April, and your April to June quarter or something like that. And remember, it's based on projections. So if you project April to June,
but you do better.
Yeah, and you end up doing better. Well, I mean, the Commissioner has stated you don't necessarily out of JobKeeper. It doesn't mean you stop getting it. It just means you should be able to back yourself, because they're just going to, if they do come and have a look, you can support why you did what you did. So it's not I think the point I'm saying is that don't do just the back of the envelope. Oh, good, we're in, off we go. You know, make sure you understand why you do it, what numbers, where you got it from, and your best intent at the time. So I've got another question there.
I'll get you the next ones from Salil. If we enrol our service entity before 31 May, can we still claim for April fortnights? And can we still make top-ups for the April fortnights after the 8th of May?
Yeah, this is the bit that's a little bit, so no, you won't get April if you don't do the top-up. So you need to top up by the 8th of May. So the question is what you're struggling with at the moment, what's causing you to concern. You do have time until the 31st of May. This is why sometimes the dates don't quite line up, because you can enrol by the 31st of May and elect all your employees by the 31st of May, but you effectively would have had to top them up by the 8th. There is no extension to the 8th so far. Okay, so I wouldn't assume there's going to be. Although if you have topped them up, because I know some employers that have topped them up but just haven't done the enrolment because they're waiting for the nominations, you know, whatever, you will get the April, so long as you qualified for the April, we'll get April and May, but instead of getting it at the beginning of May, you'll probably get it at the beginning of June. That's the only difference. So you do get April.
Yep.
So long as you make your top up.
Yep. Okay. There's another one on our chat from Arthur. If you have 15% turnover decline, will you be entitled to full JobKeeper stimulus? My understanding is no. Is that right?
Well, no, unless you're an ACNC registered organisation, and you'd know if you were. If you, I mean, this presentation's for the corporates and the private business. So the answer would be no. 15% is not for them. It is only for the ACNC registered, and within those there are some exclusions. And Arthur, would you be a not-for-profit?
And Mariana, we haven't seen a not-for-profit which hasn't been, which will probably hit the 30%, would we, at this stage? There hasn't been.
I have, yeah. So we've had some not-for-profits that are schools.
Yeah.
So they don't come within the definition. They're excluded. They're an ACNC registered.
And Arthur's corporate.
Yeah, no. So Arthur, no. Buckley's at 15%. I know we did have 15% in the slide, but because we do the same sort of similar one for the not-for-profits. But no, it'll be 30% for you. So you've got to look at your aggregated turnover. If it's under $1 billion, then it's got to have a 30% or more decline in turnover. If you're 1 billion or more, that means you're a significant global entity, and you'll know if you are. You may not be in Australia, but your parent and all the global entities connected with you are. Then you'd be the 50%. You look at the 50% or more.
And there was an example of one of those that discovered that they were a global entity when they one of the supply chain for Virgin or for Qantas discovered they were owned by Emirates, and that meant that they weren't eligible. Because the other issue about being eligible for JobKeeper means that you're also eligible under the code of conduct for the landlord structure. So that is one of the reasons why a few people who we've been speaking to are actually making sure they're eligible for JobKeeper, but not necessarily drawing the cash, because they would rather utilise the landlord code of conduct to get their discount that way and pay their staff. So people are using it in multiple different ways.
Yeah, and look, Arthur, you've said that you are 50%. Yeah, I mean, you can still have that decline. And just one thing to watch is you might not have it for April, March and April, or the quarter, but you may have it for May. So keep testing. You may have it for June, and if you don't, you could still fall into the July to September quarter. So you get 3 months worth. So I don't, and when would you apply? Well, usually the first fortnight of the month, you could do projections. But then again, if you've got that issue, you can always bring us to have a chat.
Okay, I think that's, unless there's any more questions, we might let everybody get on with their day.
All right, thank you.
All right, thank you, everyone.
Thank you. There's a final JobKeeper if you want to know a bit more and you want to talk to Mariana about JobKeeper and going through all those sort of queries. She's always able to answer them relatively quickly because she's been immersed in it for a number of weeks now, and James obviously knows exactly what's going on with the banks. So any of those sort of things, please let us know and we'll get in touch just to have a chat and work through any issues that you might have to try and get out the other side.